I want you to imagine looking at the stock market back in the late 90s, like right before algorithmic high-frequency trading just took over completely.
Oh, yeah, that tiny window of time.
Exactly. There was this brief, incredible window where a few people realized that machines could execute trades based on data patterns that were entirely invisible to the human eye.
Right. They saw the future, they built the plumbing, and they capitalized on it before the rest of the world even understood what was happening.
And today, I really feel like we are entering a brand new financial phase that feels exactly like that, but on a much larger scale. Artificial intelligence and prediction markets are rapidly converging, and a massive new window of opportunity is opening up. Welcome to today's deep dive. I'm your host, and I'm here with our resident analyst to break this all down.
Thanks for having me. And, it really is a foundational shift. If you are listening to this right now, think of this conversation as sitting in a room with a couple of insiders who have spotted an explosive trend just before it goes mainstream.
Yeah, we aren't talking about some flashy new consumer app here.
No, not at all. We are looking at a fundamental rewiring of how risk, probability, and human earnings are traded globally.
Which brings us to our mission for today's deep dive. We've acquired a presentation deck for a project called PolyWin, and they are actively trying to capture and really amplify this exact trend.
Right, and we need to figure out if this is just another clever trading tool
Mhm.
or if we're looking at the foundation of a completely new financial ecosystem.
Because when you look at the mechanics in these sources, it reminds me so much of those early days of algorithmic trading. Except now, instead of just trading traditional stocks, the AI is trading real-world probabilities, like the likelihood of future events happening.
Well, the pedigree behind PolyWin is what makes this really worth analyzing. I mean, this isn't a team starting from scratch in a garage hoping to figure out decentralized finance.
Right, they have real backing.
Exactly.
Yeah.
The foundational architecture comes directly from the core development system of Polymarket. And Polymarket is already a massive, proven player in the prediction space.
Yeah, the sources mention you have co-founder level background members involved, specifically developers like Liam Kovacs and David Rosenberg.
Right. They understand the underlying architecture of decentralized probability networks intimately, but PolyWin is taking that existing foundation and bolting a completely new autonomous engine onto it.
So let's unpack that core engine, because they call it the Poly AI Claw system. And they make a very bold claim right out of the gate. They say you don't need any prior prediction market experience to use this. Like zero.
None at all. The entire process is fully managed by this system. It's built on transparent rules, clear cycles, and verifiable logic.
But I want to understand the actual mechanics. I mean, how is it executing?
To understand the mechanism, you really have to look at how humans fail in traditional prediction markets.
Okay, fab.
Normally, a user does the research, guesses the outcome of an event, places their capital, and then manages their own emotional risk. PolyWin flips that entirely.
So the AI takes the wheel.
Exactly. The Poly AI Claw system handles the decision intelligence and the execution strategy without any human input. Let's look at how it operates in short cycle markets, say a 5-minute Bitcoin price prediction market.
Okay, walk me through that. What is the AI seeing that a human trader isn't?
So the AI is constantly scanning the order book for microscopic pricing errors. It's looking for price deviation opportunities.
Like an arbitrage play.
Basically, yeah. Say there's a $50 to $100 fluctuation in Bitcoin's actual price across different exchanges, but the prediction market hasn't updated its odds yet.
Oh, so there's a slight delay.
Right, a tiny latency. The AI spots that latency instantly. Then it capitalizes on last-minute entry advantages. It will routinely execute trades in the final 30 to 60 seconds of a betting window.
Wow, in the last 30 seconds.
Yeah. Human reaction time simply cannot calculate the shifting probabilities, assess the spread, and execute a blockchain transaction in that tiny window, but the machine can.
So, to use an analogy, it's not like having a grandmaster play chess for you. It's more like staking a card counter at a blackjack table.
That's a great way to look at it.
Because the card counter isn't magically predicting the future, they are just mathematically tracking the remaining deck and only betting heavily when the statistical edge shifts in their favor by fractions of a percent. You just provide the bankroll and let the math work.
That is exactly what the claw execution strategy does.
But I have to push back here for a second. Prediction markets historically are built on the concept of the wisdom of crowds.
Right, the idea that a large group of people collectively guessing is surprisingly accurate.
Yeah, so if Poly AI does all the thinking and all the trading, Aren't we just betting that their algorithm is fundamentally better at exploiting the crowd's emotional errors?
I mean, yes, that is the core wager here. It is the ultimate algorithm versus human nature advantage.
Algorithm versus human nature.
Exactly. The wisdom of crowds is generally accurate over long horizons, say, predicting who will win an election 6 months out. But in hyper short cycles, crowds are terrible at probability.
Because they panic.
They panic, they're emotional, they're reactive, and they are super prone to overconfidence. The poly AI claw system doesn't feel fear. It doesn't feel greed. It just calculates statistical probability and executes.
So, by completely removing human emotion and inexperience from the execution side, the system is attempting to structure a very specific, sustainable profit model.
Right, which brings us to the actual profitability logic.
Which brings us to the money, yeah.
Yeah.
And this is where I have some serious questions. If this engine works, how is the profit actually structured?
Well, the presentation deck details what they call a dual yield engine.
Right. And the first half of that is the static yield, which is driven entirely by the AI's automated execution, probability models, and risk control algorithms.
Yes, and it operates on fixed cycles, fixed settlements, and fixed yields depending on how long you lock up your capital. The tier structure actually reveals a lot about how they manage liquidity.
Let me just summarize the concepts for you guys listening before we look at the math, because the numbers are what set off my alarm bells.
They are quite high.
Very high. They offer escalating fixed yields depending on your commitment. The baseline is Poly A, which is a 60-day lockup that pays a 2% daily yield.
2% daily.
Yeah. Then Poly B shortens the cycle to 45 days and bumps the yield to 3% daily. And then there's Poly C, the accelerated tier. That's a 40-day cycle offering a 4% daily yield.
And don't forget the loyalty mechanism.
Right, right. If you complete a cycle and repurchase, it boosts your total yield by another 10%. So Poly A goes from 120% total to 132%.
You know, providing fixed structured yields in a highly volatile market is a massive psychological draw. It converts a complex, risky environment into a highly structured, replicable wealth generation tool.
Hold on, I need to stop right there. Earning 2 to 4% daily is an incredibly aggressive claim. I mean, in traditional finance, if you promise someone 4% a year, they are thrilled.
Oh, absolutely.
4% a day is wild. In decentralized finance, numbers like that usually mean one thing: a Ponzi scheme, where new user money pays off the old users until the music stops.
It's a valid concern.
So you have to explain to me how the combination of probability models and risk algorithms could theoretically sustain this. How does this system not just collapse under the weight of those payouts?
It sounds like a massive red flag until you separate asset appreciation from high-frequency arbitrage.
Okay, unpack that for me.
Traditional finance relies on asset appreciation. You buy a stock and hope the underlying company grows in value over a few years. PolyWin isn't doing that at all. They are operating purely in the probability space.
So they aren't holding anything waiting for it to go up.
Exactly. In global prediction markets, billions of dollars are wagered daily on volatile, short-term outcomes. The inefficiencies, the pricing errors made by human traders are constant.
Oh, so they aren't waiting for something to go up in value. They are just skimming the mistakes of other traders.
Precisely. By utilizing high-frequency arbitrage across these probability markets, taking advantage of those 30-second entry windows we talked about, the algorithm is harvesting micro-profits thousands of times a day.
Thousands of times a day.
Yes. If you make a tiny 0.05% profit on a trade, but the AI executes that trade 10,000 times a day using a massive pool of capital, a 2 to 4% daily aggregate yield is mathematically synthesizable.
So it is essentially functioning as an automated market extractor.
That's the perfect term for it, yes.
Okay, I follow the logic of high-frequency micro-arbitrage. But the algorithm might be a genius, but a genius without capital to deploy is just doing math in a vacuum.
It needs fuel.
Exactly. To execute 10,000 trades a day and hit those yields, you need a massive war chest. Which leads us to the second half of PolyWin's dual yield engine, the dynamic yield.
Right. This is how they actually get the money to feed the machine.
The static yield is the AI doing the work, but the dynamic yield is the community doing the work. And their community building structure is relentlessly aggressive.
It really is. They are using what they call a 3x3 matrix designed for exponential network explosion. They are explicitly targeting over 59,000 core nodes.
Let's break down what a 3x3 matrix actually means mechanically, because it's not just a buzzword.
No, it's a geometric progression. You refer 3 people. Those 3 people refer 3 people, making 9. Those 9 refer 3 each, making 27.
So it forces vertical and horizontal expansion simultaneously.
Right. And the dynamic tier rewards span up to 30 levels deep, with a combined maximum reward cap of 15% paid out to the network.
Which is huge. But the barrier to entry is kept intentionally low, right? Like a minimum of $100.
Yeah, just $100, but they heavily incentivize deeper capital commitment.
Because if you only deposit $100, you only earn rewards on a few levels.
Exactly. If you want to unlock deeper reward levels of the matrix, you have to bring more capital to the table. So a direct deposit of $1,500 unlocks 15 levels.
And if you step up to $3,000, you unlock all 30 levels of the referral matrix.
Notice how the incentives align here. It's an aggressive customer acquisition strategy. They are engineering a liquidity vortex.
A liquidity vortex, I like that.
The high static yields attract the initial user, and the 30-level dynamic matrix weaponizes human networking to scale the total capital pool exponentially.
And all of this runs entirely on-chain for transparency. It's built on the Polygon network using USDC stablecoins, right?
Yep. They execute daily settlements right at noon. The minimum withdrawal is $100, and there's a 5% fee on the back end, which helps sustain the protocol.
But look at what we are describing here. A 30-level affiliate matrix paying out up to 15% combined, layered on top of a 4% daily static yield. It's like strapping a highly aggressive, multi-level marketing structure to a decentralized hedge fund.
I mean, when you put it like that, yes.
So my concern remains. In DeFi, this specific structure usually collapses when user acquisition slows down. If the network stops growing, does the yield die? Like, where is all this capital actually anchoring so it doesn't just evaporate in a bank run?
That's the million-dollar question. If the platform relied solely on paying out USDC infinitely, it would eventually face a severe liquidity crisis.
Because the money has to come from somewhere.
Exactly. That is the vulnerability of every aggressive yield protocol. And that is exactly why the entire system is anchored by their native asset. This brings us to the tokenomics, which are designed specifically to act as a dam against that liquidity drain.
Okay, the PolyWin ecosystem equation and the PW token. They actually write this out as a mathematical formula in the deck. Polymarket plus AI agent plus DeFi equals PolyWin market. And the PW token is the core asset of this entire ecosystem.
The tokenomics are fascinating because they break all the rules of standard DeFi projects.
How so?
Normally, a protocol prints an infinite amount of tokens to pay out yields, which hyperinflates the supply and drives the price to zero. We've seen it 100 times.
Oh yeah, the classic death spiral.
But PolyWin doesn't do that. The total supply of PW is strictly capped at 21 million tokens.
Taking a page right out of the Bitcoin playbook, hard capped at 21 million.
Furthermore, there is zero inflation. No new tokens will ever be minted or issued beyond that cap.
So how do you get them?
The way you acquire them early on is purely based on contribution to the network. Specifically, a $10 contribution equates to 1 PW token. But crucially, early participants get a massive structural advantage.
Right, I saw this. They receive lower lockup ratios.
Exactly, meaning their tokens become liquid faster while later allocations will face stricter limits to prevent dumping and market manipulation.
Let me stop you there and just look at the geometry of this, because I see a massive collision course.
Okay, what do you see?
The token supply is permanently hard capped at 21 million. But the ecosystem is explicitly designed to scale exponentially through that 3x3 matrix up to 59,000 core nodes and beyond,
Yes.
bringing in millions in liquidity. So if everyone is rushing in to participate, but the token supply is entirely fixed, won't this inevitably create a massive liquidity crunch? What happens when an exponentially growing user base tries to grab a piece of a fixed pie?
You've identified the exact core economic engine of the project. It is a deliberate, mathematically induced scarcity.
Deliberate scarcity.
Yes. By hard capping the token supply while aggressively forcing the expansion of the user base through the matrix, PolyWin is creating a bottleneck of demand. As the platform grows, the utility of the PW token increases.
Because you need it to actually use the platform.
Right. You need it for trading fee discounts, for enhanced yield incentives, and eventually for platform governance.
So the token isn't just a speculative meme coin.
Yeah.
It's the key to using the system.
Exactly. And because the supply cannot expand to meet that demand, the fiat value of the token is mathematically forced upward to reflect the growth of the platform's liquidity and user base.
Wow.
It transitions the token from a speculative asset into a true index of the ecosystem's health. It's a strategy designed to force long-term ecosystem value capture rather than, a short-term pump and dump.
Which tells me they aren't just thinking about surviving the next 6 months of the crypto cycle. They are setting the stage for a much larger global infrastructure play.
They definitely are.
And they lay that out in what they call their trillion-dollar vision and roadmap.
Yeah, this is where we shift from looking at PolyWin as just a profitable bot to looking at it as foundational infrastructure. They outline a 3-phase ecosystem development roadmap.
So where are we right now?
Phase 1 is where we are now, accumulating core capabilities. This is all about deeply optimizing the Poly AI claw model, proving the 2 to 4% yield is sustainable through high-frequency arbitrage, and building that initial loyal user base through the matrix.
Basically, get the engine running perfectly and get people in the door.
Right. Then phase 2 is where they transition into what they call the rule maker. This involves the launch of the actual PolyWin market itself and deploying a proprietary AI automated market maker, or AMM system.
Okay, break down what an AMM actually does in this context, because that's a pretty heavy technical term for some folks.
Sure. Think about a traditional sportsbook or a prediction market like the early days of Betfair. It relies on order books. If you want to bet $50 that an event will happen, the market has to find another human being willing to take the other side of that bet.
And if it can't find them, the trade just doesn't happen.
Exactly. An automated market maker replaces the human on the other side with a mathematical formula and a pool of liquidity.
So it's like a robot bookie that automatically adjusts the odds based on where the money is flowing, rather than relying on human buyers and sellers to match up.
That's a great way to describe it. But PolyWin is taking it a step further by integrating AI directly into the AMM. Their AI won't just adjust odds based on capital flow, it will adjust odds based on real-time external data and probability models.
Oh, wow.
Yeah. In phase 1, they are an AI agent extracting value from existing markets. But in phase 2, by deploying this AI AMM, they essentially become the market. They dictate the rules of liquidity and probability pricing.
And if they become the market, that naturally sets up phase 3. Which they call full ecological expansion. They want to expand this underlying infrastructure into traditional sports, global politics, esports, and even KOL consensus markets.
Now, the KOL consensus markets are particularly interesting to me. KOL stands for Key Opinion Leader, basically massive influencers. Imagine a market where you aren't betting on a sports game, but you are trading probabilities on what a major tech CEO will announce next week, or what a financial influencer's next stock pick will be.
That is wild. So the AI AMM can instantly spin up a liquid market for any event, no matter how niche, as long as there is data to track it.
Exactly. The ultimate goal stated in the deck is to become the foundational infrastructure for all prediction markets. They want to establish an absolute industry standard for AI probability pricing.
And they frame this as capturing a piece of a 308 trillion value global wealth restructuring, which is a massive number.
It is, but that 308 trillion number isn't just marketing fluff. It represents the total addressable market of global financial derivatives and betting markets eventually transitioning onto the blockchain.
Right.
What PolyWin is banking on is the idea that prediction markets are the ultimate financialization of reality. Every future event has a probability. If it has a probability, it can be priced. If it can be priced, it can be traded.
So they want their AI to be the engine that prices reality.
That's the end game, yes.
Here is the best analogy I can think of for their trajectory. It's like Amazon Web Services, AWS.
Oh, that's interesting.
Think about it. When Amazon started, they just sold books to consumers. But to handle their own massive growth, they had to build an incredible internal server infrastructure. Eventually, they realized the infrastructure they built to run their store was actually more valuable than the store itself.
So they started renting the infrastructure to the rest of the internet.
Exactly. PolyWin is starting with a consumer-facing tool, the AI trading bot that gets users those aggressive daily yields. The bot and the matrix are just the customer acquisition strategy. It's how you bootstrap a massive, loyal user base and deep liquidity pools.
Yeah, that makes perfect sense.
But their end game is to become the underlying plumbing, the core AWS-style infrastructure that the rest of the entire prediction market world runs on. They want to build the rails for the next generation of decentralized finance.
I think that is a perfect parallel. It really shows how they're transitioning from a tool to a platform and finally to core infrastructure.
So let's put it all together. If you are listening to this and trying to figure out what to do with this information, here is the synthesis. PolyWin is a project attempting to capitalize on the massive, early-stage trend of AI-driven prediction markets.
They are early to the party, but they are accelerating fast.
Yeah. They are taking the guesswork, the human error, and the emotion out of probability trading by using the Poly AI clause system to automate execution and exploit short-cycle market inefficiencies.
And they are fueling the growth of that AI engine with a highly aggressive, geometrically expanding dynamic yield network.
The 3x3 matrix.
Right. By combining rapid liquidity generation with a strictly capped zero inflation token, the PW token, they are offering a highly structured, scalable model. The ecosystem is explicitly designed so that early adopters, the ones who get in while the network is expanding and the token supply is locking up, hold a massive structural advantage.
It's a fascinating blend of cutting-edge AI execution and relentless network economics. But as we wrap up this deep dive, I want to leave you guys with one final thought. Something to ponder that wasn't covered in their presentation deck. But it just feels like the inevitable conclusion to this entire sector.
All right, let's hear it.
The entire profitability model of PolyWin currently relies on the Poly AI system being smarter, faster, and colder than emotional, irrational human traders.
Right. It's the algorithm harvesting the mistakes of the crowd.
Exactly. But think about what happens in 5 or 10 years. If tools like PolyWin are successful and become the absolute industry standard, well, eventually everyone will be using highly rational, emotionless AI agents to trade probabilities.
Oh, wow. Yeah, the inefficiencies vanish.
Right. Will the human errors that currently make this high-frequency arbitrage so incredibly profitable simply disappear from the market? In a future where AI only trades against other AIs, all operating on perfect logic and instant data, who actually wins?
That's a terrifying but fascinating thought.
Does the market flatline into perfect efficiency, or does the AI arms race just escalate to a level we can't even comprehend? It's a fascinating financial evolution and absolutely something you should keep a close eye on as this technology unfolds.